owner, key advisor, wealth management. Eddie, as we're here just off some recent highs, what do you think? Because we've got jobless claims and, folks still saying the Fed has all the reason and fodder it needs to raise again and maybe even once more. What are your thoughts?
Yeah, I do. I think the Fed, I think everyone knows, or at least is expecting them to raise rates next week. The biggest risk to me in regards to the market here in the near term is this whole battle with inflation. The last inflation print that we got caused a pretty nice rally because I think sentiment and consensus thinks that this fight with inflation is over. When you take a look at oil prices, that's making me a little bit nervous because oil prices and energy prices was helpful in getting inflation down. And let's not forget either, we were also comping it off of peak inflation last June. So the base effects are going to get tougher here for inflation. And if we get a reacceleration of inflation, that absolutely is not priced in to the market, in my opinion. And I think that inflation is going to be stickier than many believe. So today's pullback, I don't really look at it as any big news. We've had a major run up here, obviously, and some of these names that are down have had substantial run ups. But as you know, we continue to be pretty cautious. We're picking our spots on what we're buying here since this past month. But we're keeping plenty of dry powder because we do not think we are out of the woods yet.
So you're saying that folks are just getting a little too optimistic, thinking there's no recession, inflation is finished, and you want to be cautious until what? What will change your mind where you turn and become a little more risky, a little more bullish?
So number one is on the inflation front. Again, I think the market is pricing in that this inflation battle is done, and I don't think we're near done. And the bigger thing is, I think you're starting to hear more and more people use the term soft landing, that we are not going to have a recession. I respectfully disagree with that. I think when you look at economic indicators and you take a look at the consumer, you got student debt payments that are going to start coming in. Something has to give. This cost of capital that we're in, even if the Fed doesn't raise rates one more time, the biggest problem is the cost of capital is not going to go down. It's going to stay at these levels. We're going to be higher for longer. And with the amount of consumer debt that we have in a consumer-driven economy, with student loan debt as a headwind, where is the growth from the consumer going to come from? So I think we are too optimistic looking forward and thinking that we're going to be able to navigate this perfect landing in a time period where we've never seen rates rise this fast in this short a period of time, and we've never seen debt levels at the current level that we're seeing. So it's been a very resilient market. It's been a very resilient labor market. But the only way you're going to get down to 2% inflation and get labor costs down, unfortunately, in my opinion, is a recession.
All right. So while you think you need an investment strategy here, you said there are sectors that are overbought and there are others that show some promise. How would you define those?
So right now, the areas that we are bullish in, because look, even though we're bearish on the economy, we have to respect the momentum here in this market from a technical perspective. So last month, we started buying some healthcare. We bought India. And just yesterday, we bought the dip in aerospace and defense. That's an area we've been watching closely. We got a good entry point, in our opinion, yesterday. Those positions are holding up very well today. We think healthcare, aerospace and defense, from an earnings standpoint, are going to have a pretty good back half of this year because there's easier comps. They also didn't perform well in the first 6 months of this year. And then we also looked outside the U.S., and I don't think anyone can question the fact that India is taking business away from China. When you look at companies like Apple and Amazon, India, in our opinion, has a chance to be the next China. So there's going to be tremendous growth opportunities over the next several years there. And for us, we wanted to diversify outside the U.S.
Right. It's interesting how you said India. No Asia, other emerging markets, for example.
Right now, we're just sticking with India. We think that has the best risk reward right now. Because, again, you look at Europe. Europe's in a recession. China's seeing a slowdown. So this global economy is slowing down in many parts of the world. And we're just trying to pick our places in an area that we think growth is accelerating, not decelerating.
Yeah, understood. What about some of the areas that have been high flyers? You have had AI, anything related to AI. You've had the Magnificent Seven. A lot of excitement surrounding travel as the airlines have been moving higher and cruise lines and seeing a lot of demand. I mean, do you have any interest? I know you've actually put a lot of money on the sidelines to put that to work when you are ready. I mean, what about some Meta has been an exciting story. Tesla has been an exciting story. Even Netflix has been at new highs. I know some of these are pulling back. When do you get in on all these names?
Yeah, look, hats off to anyone that picked those at their lows at the end of last year. But I think even those bulls would admit that it's time for a breather in those sectors. And it's healthy for the market to have breathers. It's not a bad thing. And so, if we were in those high flyers, more than likely for our clients, we would be taking some off the table. Those areas, the higher risk areas that have had the biggest run up, in our opinion, have the biggest downside potential if we don't have that soft landing. So we're not going to get in those higher beta names until we get confirmation here in the coming months on whether it's a soft landing, hard landing, or what that's actually going to look like. Because those that have had the biggest run up again have the chance to have the biggest downdraft. And that's when we'll pick our spots and getting in those. And look, AI has been a hot word. Like we joke in our office that all you have to do is say AI and that stock will go up. It is the future, but many companies haven't monetized that yet. So we're going to have to see this AI turn into profits for some of these companies. So it's going to be interesting as we go to the next 2 quarters earnings with these companies that used AI in their conference calls last time.
Yeah. Eddie Ghabour, great to see you. Thank you so much. Key Advisors Wealth Management.
Thank you.
Thanks, Eddie.